Good afternoon, everybody. My name is Matt Jahn, and I am the insurance specialist with OJM Group. Today, I'd like to spend just a few minutes of your time talking about long-term care insurance and long-term care planning, and how having a good long-term care plan can help to make sure that once you reach retirement, all your retirement goals can be met. On your screen right now are just some standard disclaimers for OJM Group. If you take a second and just read through them. Of course, you can always pause your screen if you'd like to read them in detail. Here are just a list of the few books that have been published by the principals of OJM Group. You can contact us at any time if you'd like to receive an electronic version of it or a hard copy of it. Just a list of the main services that OJM Group can provide on your behalf. And now for the topic that we'll be covering today. We're going to spend just a couple of minutes talking about long-term care planning in general and what goes into long-term care planning. It is a lot more than just looking at insurance products. Then we'll talk a little bit about how insurance products or other types of funding vehicles can be utilized to help protect your retirement plan. We will also spend a good portion of the time talking about tax benefits that are available for a good portion of the types of insurance contracts that can be purchased on the market today, both from an individual standpoint as well as from a corporation standpoint. There are actually quite a few tax savings that can be realized. And then to look at some of those tax savings, we'll do an example looking at what a C corporation would be able to do. So jumping right into this, I want to ask you, before we start talking about long-term care planning, is for you to think about what disability planning is. If I were to guess, I would bet that the majority of you listening to this call probably have disability insurance in some form of another. Long-term care planning is almost the same thing as disability planning. With disability planning, you are in your working years, you're making an income, you're setting all of your plans for retirement. Disability is protecting your income. If you should become disabled while you're working, you're able to use that disability plan to make sure you realize all your retirement goals that you've put down for yourself. Long-term care planning is the same thing, just from a different stage. Instead of looking at your retirement plan from the point that you're still making income, long-term care planning is looking to protect your retirement income once you've actually reached retirement. Long-term care does also have the additional responsibility of looking at your specific situation and determining the best way to provide assistance, not just necessarily how to pay for that assistance, and also being able to maintain the goal that all of us would have if we do need long-term care, which is how do we stay at home and receive long-term care while we're at home. So long-term care is more than just a monetary planning tool. Because long-term care planning is so specialized in looking at your specific family situation, your current living situation and residential situation, and also your financial situation, it is very hard to make generic statements about the planning process, but there are typically three specific areas that you would want to look at when you're doing long-term care planning. So inside the plan, the first area that pretty much everybody is going to look at is what's going to be required to allow me, as the person who needs care, to remain at home without risking the emotional and physical well-being of those who will provide your care. This is how this is accomplished is very specific to your family and living situations. As I like to ask, do you live on top of a mountain? By this, I just mean what resources are available around you to make staying at home possible, or make staying at home possible. If you lived on top of a mountain, it would be extremely difficult to receive care while still staying at home. The second area that you want to look at um, is talking about a legal aspect of long term care planning. There is a specialized section of law that does nothing but really long term care planning from a legal and asset protection standpoint. That section is referred to as elder care law. During your working years, you do a lot of asset protection to work around securing your assets from things such as creditors and lawsuits. In your retirement years, asset protection hinges around being able to keep as much of your retirement income for its intended purposes and not having to use it to pay for care. This is also often referred to as Medicaid planning, since that is the most common form of public financial assistance that's used to pay for long term care, which is Medicaid. So when you're doing the legal aspect of long-term care planning, you're mainly making sure that assets are labeled the correct way, that you have durable powers of attorney, both medical and financial. Of course, all your typical estate planning stuff as well, like wills and living trusts, things like that. Finally comes the third part, which is the part we'll spend the rest of our time discussing. Other than Medicaid planning, which a lot of that does depend on transferring assets out of your name, which means giving up control of those assets. How do we help to ensure that our retirement planning isn't devastatingly affected or affected by a long-term care situation? So, there are a lot of different ways that you can find the funds to pay for long-term care. The first, and what most people do to actually cover the expenses of long-term care, is utilize your income. When you do your retirement plan models and you look at forecasting and you look at the resources you have, if those resources have the bandwidth to accept the charges that may occur because of a long-term care situation, then from a paying for a standpoint, there's really not much else to do. And for a lot of you, that will be the situation. But it's just nice to know that you have enough income being generated into retirement to pay for long-term care. The next one is your family. And while none of us want to rely on our family to help cover medical costs, the realization is that the majority of the time that is where we ultimately end up having to go if we don't have enough resources of our own. There are community and government programs. Of course, the biggest one is Medicaid, but there are a lot of federal, state, and local programs that not only can help you monetarily, but can also be there to help provide support services and supply care services as well. Of course, what we'll talk about for the remainder of this webcast is insurance. And insurance, just like with anything else, when you're looking to cover a risk, insurance can sometimes be the most efficient way to do that. And then finally, you have a combination of all of these. And this is usually the makeup of a long-term care plan. You don't insure your entire possible need because when it comes to long-term care, it's a big question mark whether you'll actually ever need long-term care. So you don't want to be overinsured and have spent all this money on insurance that you don't need. So just having a decent base of insurance can sometimes be the appropriate way to do long-term care planning. Of course, you'll always have to utilize some of your own income. More than likely, when we're doing planning, we're going to set a plan in place that will not require any financial assistance from family. And our goal is to try and make sure that you don't have to rely on Medicaid. But the nature of long-term care needs is eventually, if it goes on long enough, looking at government assistance is always a possibility. The types of insurance that are out there. Over the last 10, 15 years, there has been quite a renaissance when it comes to long-term care insurance products, mainly because of all of the changes that have had to occur to your individual traditional long-term care insurance, which has seen a lot of price increases and benefit reductions over the years. So going through this just rather rapidly, individual long-term care and group long-term care, they're basically the same product. It's just where you purchase it. Individual long-term care, you're going directly to the insurance company. Group long-term care, you're getting through your employer, but it's the same contract or same product that you would get if you went to the company on your own. You just get discounts if it's being offered in a group setting. So even though costs have gone up, um, and it still and probably always will, though, be the lowest cost of long-term care insurance. And the reason for that is with individual and group long-term care, all you're buying is the actual reimbursement long-term care insurance. Unlike the other versions where you're getting things like cash value and death benefit and return of premium guarantees, those features on the three remaining products are not inexpensive. So individual and group long-term care can a lot of times be the lowest cost way to get long-term care coverage. On your asset-based life and annuity products, these are products that do offer true long-term care insurance, just like traditional and individual long-term care, but they're backed by a life insurance or an annuity policy, which means they also offer guarantees on things like cash values and death benefits. They the reason they came about was to address the primary objection to regular long-term care insurance, which is the use it or lose it provision, just like your auto insurance. If you don't have a claim on your auto insurance, you don't actually see any money from the insurance company. With individual long-term care or group long-term care, if you don't need long-term care services, you don't get anything out of the policy. With the asset-based long-term care contracts, you are always going to see a benefit out of the policy, whether it be long-term care services or it's a death benefit or cash value. You then have life insurance with a long-term care access rider. This product is still typically a design to fill a need for life insurance. It just gives the ability for the death benefit to be used for long-term care if you need it, but it's not designed to be 100% a planning tool for long-term care. It's more of as an additional benefit. You need a life insurance policy, and in addition to that life insurance policy, if you need long-term care, you have the option to access your death benefit for that. Okay, so talking a little bit more, one more topic on individual long-term care. While individual long-term care has, over the last few years, had some pretty bad press, mainly around the price increases that they've had to impose on people who already have their policies, there is one very unique feature that you can only get with an individual long-term care or group long-term care policy, and it does make it a very attractive solution, even if you're just going to purchase a small, tiny, little long-term care policy, you're able to utilize these additional benefits. This additional benefit is referred to as care coordination, and the screen is broken into two sections. You have the top two bullet points, which every product type on the previous slide, whether it be traditional long-term care, asset-based life or annuities, or just a life insurance policy with long-term care access, they all offer these first two bullet points, which is no different than, say, the health network of providers that your health insurance offers. There are networks of long-term care providers where the insurance companies have, one, negotiated discounts for their costs, and two, in order to be part of this network, you have to go through due diligence with the insurance companies. So you know that the long-term care providers in this network are reliable providers. So everybody offers those 2 bullet points. The bottom 4 bullet points are services that only traditional long-term care providers offer. And these are actually very, very beneficial, right, or very beneficial benefits. And I can speak personally from this. When you need to set up care for someone, it's 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 just extremely hard to know where to start at. So these additional features, the first one listed there is assess care needs. Now, this doesn't mean the insurance company is telling you whether you need care or not. That's actually between you and your doctor. Your doctor certifies that you need care, and that triggers the long-term care insurance policy. Assessing care needs is a specialty where the insurance company hires long-term care specialists that can come into your home and help determine what type of care do you need, what special situation is occurring for you. Things such as, do you need a door widened or do you need a wheelchair ramp? They specialize in making sure they catch all of the little things that the rest of us would never think of. The second is they will actually help you write up a suggested plan of care, which is, this plan of care is going to literally be a step-by-step process of, how do we help our family member that needs care? Who do we call? What care providers are we going to use? Who are we going to go to make sure that our grandparents' yard is still taken care of, the grass is cut, the gutters are cleaned out each fall. The suggested plan of care is going to cover all of those little intricate details that most of us would never think of. They also will help you locate public resources. This isn't necessarily financial support, but they will help with financial support. This is more social support. They will help you locate what services does your state, does your county, does your city offer for people who do need long-term care. And then finally, and this is probably the most beneficial aspect, if you have a long-term care policy on yourself, but let's say one of your parents needs long-term care and they don't have insurance, because you have a policy and therefore you are by definition now a caregiver because it's your family member, all of these bullet points your policy will provide to you to help your parent or your sibling or your child, anyone in your immediate family. So that's going parents, grandparents, your children, as well as your siblings. All of these bullet points on this screen will be provided free of charge to your family members for you to help them with the care coordination involved. Okay, funding of long-term care insurance. In 2006, there was a tax bill basically referred to as the Pension Protection Act, and it was there mainly for pension funding regulations. However, a lot of material went into the Pension Protection Act around long-term care insurance, both tax benefits for funding long-term care insurance, as well as beefing up the ability for any long-term care payments you receive out of an insurance policy being tax-free benefits regardless of how the policy was funded. So as you look through this, you'll see that pretty much the majority of these contracts, in some way, shape, or form, and maybe not 100%, but at least some proportion, can be funded with pre-tax dollars. All of them will still provide tax-free benefits. It has also been added in by the Pension Protection Act that if you have non-qualified deferred annuities, if you have life insurance with deferred growth in it, you can use that deferred growth to pay for long-term care insurance, and the IRS will forgive any taxes on that deferred growth that you use to pay for long-term care. No mystery here. The government is trying to protect Medicaid. It is running out of money pretty rapidly, and a big portion of that is due to long-term care expenses that it's covering. So the government is doing everything they can to try and get people to cover their own expenses by purchasing insurance. And the best way to do that is to give lots of tax benefits around insurance products. Now, there are a lot of footnotes on here, and you will find those footnotes located on page 16 once we get there. When it comes to who funds the long-term care insurance, it can be funded both from an individual basis, you go out and buy your own insurance, as well as being provided by an employer. A lot of you are probably small employers yourself with just one or two employees, or maybe even just yourself as an employee, which opens the door to have a lot of tax savings. And what I'd like to do now is talk about an example using a C Corp. So if we look at someone who has a C Corp, the way the tax law is written, the C Corp can pay for long-term care insurance on the employee and the employee's family. So if we look at a practice where just the husband or the wife owns the practice, own the employee, and they want to fund a long-term care policy, they want to have the policy be funded by the time they get to retirement at age 65. So we're going to look at a 10-year policy, and they want it to be guaranteed. So in order to have it be guaranteed, we do have to move away from the traditional long-term care and look at asset-based products. So we're going to look at a unique second-to-die life insurance policy with a lifetime long-term care benefit rider. We work through the numbers. If we were to purchase this couple a $250,000 policy, the $250,000 is guaranteed. It will be paid out on the second death if the money is not used for long-term care. There is a guaranteed cash value that grows, not necessarily a guaranteed return of premium that I've paid. It will eventually get there, but this contract will always have a net cost. You get an initial long-term care benefit of $5,000 each per month, which means if both spouses would need care, the insurance company could be paying $10,000 a month. And it does have 5% compound inflation, which means in 30 years at age 85, that $5,000 a month has grown to $21,000, $22,000 a month. Now the annual 10-year guaranteed premium, which means after 10 years, no more premium. The insurance company cannot raise these premiums and can never ask for more premiums. $31,000. However, almost 20,000 of that can actually be paid tax-free by the C corporation. The other 10,000, basically the 10,000 that's going towards the life insurance, not the long-term care, has to be paid by the actual owner of the contract with after-tax money. So you're looking at over a 10-year time period a total premium of $311,000. However, when you take into account the tax benefits, if we assume that you're at an estimated combined tax rate of 50%, which this would be federal, state tax, the Medicare 3.8% tax, your estimated annual tax savings is almost $10,000. So over a 10-year period, you're saving almost $100,000. So now your actual net cost for this policy is $211,000. You've just saved $100,000 on a contract who, if someone was purchasing it that didn't have this business, they'd have to spend $311,000. In this little chart is just a quick view of what those guaranteed cash values are. So you can even see by year 30, you haven't gotten to $211,000 of cash value, but you have gotten to 190,000 if you wanted to just walk away and take this. That means you've got a $21,000 net cost if you cashed out the contract and just took the money. If you look at the fact that an individual long-term care policy that offered semi-comparable benefits would actually cost $6,000 per year, and that premium would actually be paid forever, you would have a much higher net cost. So these asset-based products can be very, very efficient ways to just shift some asset dollars to make sure you have long-term care coverage. And if you end up not needing the long-term care, you haven't just given up all of those premium dollars. They're there in a death benefit, they're there in a guaranteed cash value. Asset-based long-term care insurance, pretty much all the contracts out there are designed with three buckets. You have the cash value bucket, which typically is always the smallest. You have the death benefit bucket, which is always typically the second smallest. And then you have the long-term care bucket, which is what you're getting this product for. It's always the largest. However, these three buckets are able to be rearranged. So you can put an emphasis on the cash value, which will lower an emphasis on the long-term care. So you may have an asset that could be worth more in the future than what you've paid in, but in order to get that, you give up on some of the long-term care. So for instance, maybe we get rid of the lifetime benefit and just give you a 5 or 10 year benefit period. That means the long-term care costs go down, so your cash value bucket grows. So these products are very tailorable to every person's situation, and there are a lot of different products out there that we could look at for you. Okay, so here are the footnotes, which means we're coming to the end of the presentation. I'll leave this up for just a couple of seconds, and of course you can always pause to read through the footnotes. And then finally, the next steps. If you would like to request a free copy of For Doctors Only or Wealth Secrets of the Affluent, you will see the contact information down below. Just give us a call. Also, would love to be able to talk to you about your individual family situation and potential long-term care needs. And you can schedule and call a complimentary consultation at any time. And be sure to also subscribe to our free e-newsletter. Thank you very much. I hope you guys have a great